I just learned recently that the Colorado River is actually not there to support Colorado, but actually Southern California, because that's who actually drinks the most water from it, not actually the residents of Colorado, which I find interesting.
Colorado is a part of the pact. There's an upper basin pact and a lower basin pact.
But it's misleading in its name if you're a person who lives on the East Coast like I do and never really thinks about how states and the people in those states get their water, to think that the Colorado River's job is to support Southern California's golf courses and things like that are siphoning water out faster than the rest of the states that are part of the pact.
Oh my gosh, wait until I tell you about the Mississippi River or the Ohio River, both of which end up in states besides Ohio and Mississippi.
Mm-hmm. Yeah, well, so same thing. So what brought this on is I was watching this show with my daughter called How the States Got Their Shapes on like National Geographic or something like that. And one of the episodes was about the fact that the states all form their borders around waterways, and that being the real driving force over who gets what. And the contention, the way California drew its lines, the reason it's so long down all the way to Mexico is because it wanted to annex off the piece that allows it the most access to the river.
So, well, back when they wrote the pact, so this was 1922, it was the Colorado River Compact. And for listeners, I did a short piece on this, which is why I randomly know a few things about this. It's the Colorado Compact in 1922. They're like, we need to figure out how to split this water between the upper basin and the lower basin. As you can imagine, in the western United States, there's not a ton of fresh water flowing through like there is in your part of the country or even the Midwest, where there's lots of forests and waterways. And so you have the Colorado River, which was known to be America's Nile. How about that? And then in 1922, they're like, all right, there's plenty of water here, but we need to just like figure out how to split it. So what we're going to do is we're just going to go upper basin, lower basin, each get half. So upper basin, which is, I think it's Colorado, Wyoming, and one other state. I'm sorry, it might be New Mexico. And then the lower basin includes California, Arizona, and Nevada. Mm-hmm. So as you can imagine, since 1922, the needs of California and Arizona have significantly increased, while you have this pact where they basically went in Old Testament King Solomon style and just said upper basin states, you get the first half of the river, and then lower basin states, you get the second half of the river. And it's now at a point where you're getting these reservoirs going to dangerously low levels. I forget if it's Powell or Meade, but one of them has power generation plants. Mm-hmm. And it's at the point where the water is not falling fast enough to spin the turbines, which is needed for sort of backup baseline power. And I didn't know this before I started doing the story. There is not a single drop of the Colorado River that gets to the ocean because every single bit of it is used.
So it's also interesting when you can see visibly the water rings of where it used to sit versus now where it is, even with like record rainfall when it comes. It's still not nearly enough to get back to the place, where it once was. And we'll never get back there, frankly, because of how densely populated we are in some of those places and how much we consume, even with restrictions and everything else in place. So anyway, not at all what this conversation initially was framed to be as you and I were dreaming it up, but that was just kind of on my mind because you physically sit there. And this was one of those things that I was like, never really thought to care about how people who live in certain states get their water. Like, it was also interesting. People in Maine were just like walking randomly through the woods and drinking, literally like ladling water out of the stream and drinking it from there, which is something as a person who lives in DC, I would never think about doing from either the Potomac or the Anacostia River. Like, I would immediately be in the emergency room.
People were built a little bit different back then.
No. This is people today, 2026, strolling through the woods like on a hike, and they just bend down to drink water from the stream because it's supposedly the cleanest source of drinking water in America.
I thought you were describing something. Was this something you saw on the History Channel?
Mm-hmm.
Oh, okay. See, this is the equivalent of a PhD dissertation in podcasting, which is I watched something on the History Channel and now describing it on a podcast.
Yeah. No,
I got you though. I was just imagining, because we started where the states got their shapes, and now we're back there.
Yeah, no, this is within the last few years, last 5 years, let's call it.
I want to make the case this is a huge economic story, though, that people don't want to talk about because it's really difficult and complex. Like Arizona was just asked to cut more than a third of their water that they get from the Colorado River. No bueno. The way my source talked to me about it on the record, so you can find the podcast, is that it's just basically like, we've been treating these reservoirs like a bank account that was flush with money, but now we've been overspending, and now we're in this spot where, oh shoot, this isn't good. And
there's a lot of America that we have to look at and wonder what happens when the trust fund finally runs out of money.
Oh yeah. Do you want to do some episode planning right now? Because I got a few ideas for that.
Yeah, like we talk all the time about the national deficit and who's got to pay that off and when they got to pay that off, and Social Security running out, and like all the different entitlement programs, quote unquote, that get funded by, the current generation paying for previous generations and whatever. But there's so many other things in this country that we don't really lay eyes on that often, and so we don't talk enough about that. Like the trust fund eventually is going to run out, and then what happens?
Water's a big one.
Yeah.
Can I give you one optimistic note, and then we can do more direct stuff? So I also learned, though, that when you talked about overconsumption, a lot of that is agriculture. It's a lot of it is growing things in this part of the United States. It's growing things that cows eat for beef production. However, large cities, including LA, Phoenix, Denver, Colorado, Las Vegas, total water consumption over the past few decades has actually decreased as those populations have boomed, because policies were put in place by technocrats that figured out how to get more efficient with it. So there are signs that people care about this thing, and there is it's one of those things that would surprise me on the surface, that collective action makes a difference. And yes, we can agree to preserve our natural resources when we put our mind to it.
But it's going to go back the other direction once all the data centers finally get humming, because there's probably 50% of the data centers that have been built within the last 2 years have been sitting waiting to be powered on, which means they don't have any chips in them, which means they don't have any people operating them, and on and on and on. But once they finally do get brought online, once they finally get access to power, they're going to consume water too, probably as an equal opposite force to what you're talking about in terms of us needing less from being less agriculturally forward.
Okay, Debbie Downer. I was trying to do a nice little upswing. And you came in with your data centers. Why? I don't also why can't they use a pool of water that recycles?
And just recycle it?
Yeah.
I don't know the answer to that. I told you that I thought we should just be building these things in the ocean and let the ocean take care of it.
Warm up the ocean, cook the ocean.
Why not? It's going to cook anyway. We won't have polar bears in 2 more weeks. Why not just heat the ocean?
If you think Malcolm is being too depressing right now, you can email us please don't leave a podcast rating, but you can email us at thistimepod@gmail.com. I want to do one personal financy thing that we talk about investing so much on the show. We talked a little bit on investing your time. I want to talk about spending money, because I spent money in a way that really made me happy.
Okay.
For some listeners, you may know, I was dealing with the woods of unemployment for a time, and now I'm back. My household is back on a 2-income salary. And so we're not going to totally lifestyle inflate it for the fire people listening. However, I was like, now we got a little more flexibility to make a purchase out of joy. And when I tell you this is some of the best money I've spent, this may make you happy. This is one of the best recommendations I can give you if you have flexibility in your budget.
Okay.
We went on TaskRabbit and hired a house cleaner for the afternoon. And the return on an investment in terms of peace and happiness on the other side of the aisle, on the other side of these doors in this podcast recording studio, has been well worth it, Malcolm. So
that can't possibly have broken the bank, though, the way that you framed that up. That sounded like you were about to say you you bought like a $3,000 gaming computer.
No.
And that was that couldn't have cost that much on TaskRabbit.
I went on TaskRabbit. We got a cleaner, came in for the afternoon. Place is a lot better. And it was great. Sam was really excited about it. The night before, she was like vacuuming at 9:30. She has permission for me to tell this story. I go upstairs. I'm like, "Why are you vacuuming right now?" She's like, "I don't want the house cleaner to judge us." I'm like, she's here to do what you're doing right now. Like, this isn't, we're not going to the dentist and flossing our teeth right now.
I think that is the difference between having 2 X chromosomes versus 1 Y chromosome, because I have been in the exact same conversation, making the exact same argument, and just said, this is a thing that we're never going to agree on.
Yeah.
I agree on not wanting the dentist to think that, like, I don't take care of my teeth in the 5 months and 29 days between cleanings. And so I got to scrub really good the morning I know I'm going to go to the dentist. I feel like that's a little different, though.
I would agree. I made a joke about our email, but if there is something that you have spent money on that brought you joy, that's not like I bought a Rolex and now I feel like I'm a total boss, but like something where you're like, cool, I have the financial flexibility to do this. This is something that, and granted, like while I was in the season of unemployment, I was just like cutting back on a lot of things that felt unnecessary.
Being responsible. Yeah, I got you.
Yeah, this was one. It was like, we could have done it, but you're trying to just like, it's like excess services, ticketed events to like sports and concerts. It's just like there was some easy stuff that you can say no to. But now
that's also a mental thing. Like when you're in that moment in time, being able to put yourself on restriction to not spend frivolously is a mental thing, the same way that like not breaking your gym routine because today I don't feel like it, because that snowballs. And so allowing the seepage means then that the next thing you say, we can make an exception for that too. And then we can make an exception for that too. And then suddenly there's no exception and you've got a gigantic credit card bill that you're like, how'd this happen?
Exactly. And I mean, you do want to grant yourself some liberties, right? Like, you know, maybe there is a concert you want to go to. If you have the self-control to limit it to one, or, you know, once the job picture started to become clear, Sam and I went to Japan. We did it responsibly, but we're like, we're going to go do this. And so it was being extraordinarily mindful in picking your spots when you make that move to not allow the excess seepage that you're talking about. Show. Let's see what we can get into today. I bet Malcolm has thoughts on SpaceX. He has more thoughts. He has more thoughts on Spotify. Let's get into it.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
Something surprising happened with SpaceX, Malcolm, which is that Thursday last week, all of the special purpose vehicles, which were the vehicles that kind of maybe owned SpaceX stock that people traded before the IPO, those unlocked and people were able to sell their shares. They did not. And I think one of the reasons that may be due to that is basically every big analyst at a major investment bank is putting aggressive price targets on SpaceX stock. Mm-hmm. But I want to hear your thoughts on this because 7% of the shares outstanding got unlocked. That's more than the initial IPO day. That's a little weird that the stock price rose.
It's a little bit weird, except the argument that I heard yesterday from someone physically on the floor of the New York Stock Exchange was that the opportunity here now is that the additional float means that the size has to grow inside of all of the index funds.
Oh.
Which was the argument that was made the first time about there being a put underneath, or there being a floor underneath the shares of SpaceX on IPO day that were going to help propel the shares beyond 225 or 228 or wherever they got to, at their height. And we were told that as soon as they get included in the index, there's going to be forced buying that's going to send it to the moon. And we went the opposite direction. We came crashing back down to Earth. And so I am not so sure that that rescue is going to happen the same way again, that people think it is going to happen again. But I do think with the shares having been halved basically since their peak post IPO, it is more possible now that put exists than it was 6 weeks ago or whatever.
Let me explain what that is real quick in case we have a newer listener. Well, welcome. We hope you're enjoying so far. The NASDAQ set something called a fast entry rule, which meant that normally when you join a stock index, the indices like you to have a little bit of a seasoning period before you get into the S&P 500 club, or in this case, the NASDAQ club. Members convene and they vote and they say, all right, this company has settled down and it's trading enough. We can add it into the index funds for inclusions for the passive pension funds and retirement people who are buying index funds and not really thinking about individual stocks. NASDAQ went in and sort of tore that up and said, we have these massive IPOs coming online pretty soon that we want to attract to our index, SpaceX, Anthropic, ChatGPT, OpenAI. We want to be welcome to that. And so we're going to rapidly speed up inclusion into our index. And simultaneously, because these companies are only offering a little bit of their ownership to the general public, we are going to pretend like they are offering 3 times the number of shares they actually are until they get to a certain benchmark. That's the forced buying event that Malcolm is talking about. Back to your regularly scheduled programming. More of these shares are coming online. You got another 319 million shares in August later this month, and then 700 million in September. One thing that has surprised me with this so much, though, that I want to get your reaction to is just every major investment bank seems to have a 200 to 300 target price target on this stock, which is now at like 115-ish. So like nearly doubling or tripling in price for a space company that is maybe already frothily valued.
I have a few thoughts on this, only half of which I can prove. So I'll save the other half, which is more conjecture and conspiracy theory, for another conversation. I think that it is possible that there's some game theory happening where no one wants to be the one to have egg on their face and make the downgrade or the reduction in price target first, because you will be the one to be mocked openly in an earnings call when the share price goes to 350 and Elon says, Joe Smith, how dare you? Or Joe Smith tries to hit the number to get a question answered, because part of an analyst's job is asking questions on these earnings calls for the particular sector that they are covering. And if Joe Smith can't get his question answered on the earnings call because his price target is 175 instead of 375, that could also have negative implications. I'm assuming it has something to do with something related to that, but I'm not completely sure why no one seems to be willing to call a thing and say it's time for the downgrade, simply because we saw this behavior with Facebook when it IPO'd, where Facebook was the biggest, best thing we had ever seen at the time. And it was a widely anticipated IPO that ended up being a broken IPO for quite some time. And this looks so far reminiscent of that, because historically, when a company falls 50% post IPO in a month after going public, it doesn't immediately reverse course and we're off to the races. It stays depressed for quite some time.
I can't wait to hear the conspiracy version, the conjecture version, but I guess we'll talk offline about that. Continuing the parade of pessimism, I want to get to your thoughts on Spotify.
Well,
this is
Let me go back one sec.
You have more.
Yeah. I think you're skirting past another really important thing about SpaceX when you talked about.
I did price targets. What do you want?
When you talked about the term SPV, special purpose vehicle, something I was reading about that got my attention earlier this week was the number of lawsuits that have been brought against these special purpose vehicles portending to have access to SpaceX through some other vehicle that had access to SpaceX through another vehicle. So a fund of funds of funds is what ultimately was happening. And people are just now finding out, or about to find out for the first time since the IPO, that they don't actually have ownership in the company. And that is going to probably lead to even more SEC filings, DOJ investigations, and everything else into these companies that sprang up in the Bahamas, in Bermuda, in some offshore type of place, because people were so thirsty for SpaceX shares that they would take it from wherever they could get it from. And you had basically Jordan Belfort out there telling people like, listen, man, I can get you access. And in reality, all that happened was they were taking the management fee for getting people access to these startups and not actually getting them onto the cap table.
Yeah, we've asked a fund manager about that. You have an SPV of SpaceX in your ETF. How do you know you own shares of SpaceX? And you can find his answer on one of our earlier programs. It's one of those things where sometimes in investing, things will come off as really complex, and that's because you need to learn the concept. And sometimes in investing, things come off as really complex because people are deliberately trying to confuse you and hope that you can just kind of like, yeah, just accept what I'm telling you. We'll see how those lawsuits play out. Go ahead.
Yeah, I was just going to say, I think it's one we're going to end up revisiting in the not too distant future, because I think these lawsuits are going to come in hot and heavy now that people are supposed to have access.
All right. We good for Spotify?
Let's do it.
We good for Spotify time? Because this is, I want to hear you convince me on this. Seems like Spotify is at now a pretty fairly pedestrian quarter. Revenue's up 14%. They're making cash flow. One thing I don't love is that they're launching AI podcasts where you write in prompts and Spotify will send you a personalized podcast, which I wish had a different name, because I think a podcast needs a human and a microphone, but that's just me yelling at a cloud. But they're getting more action on video. Like, they are a dominant platform. When I see people using Spotify, it seems to be one of those utility, please don't take this from me services. At the end of the year, you see the photos of, I spent 600 hours on Spotify this year because people listen to it during the workday. They know all of your music tastes. They have your library and they've built in that moat. And yet you're ready to say all done now.
Yeah, so I don't disagree with any of what you just said, but I want to frame this by saying when I decided to buy into Spotify, it was 2023. The world was in a completely different place. The company was in a completely different place. People had sort of left it for dead, believing that they had lost their way because they were focused so heavily on bringing podcasts to the platform and not focusing so much on music streaming and recommending to people the things that they really wanted to hear so that they would stay on the platform longer and pay for the premium version to avoid the ads. That was where we were at the time. I think since early 2023 and now, the growthiness in the company has left the building. That is what I'm basing my overarching thesis on. So I still believe, like you, that the company is a utility in our pocket in the sense that people will continue to be willing to pay for it. The thing that's kept me loving the company to this point has been the fact that they had 2 price increases over the last 2 years, and they still managed to grow premium subscribers by double digits over that same time period. So the number that really matters is premium subscribers, not necessarily just we hit 700 million subscribers overall. Those are the people that are sort of here by day, gone by night kind of thing. But the 300 million people who are willing to pay to be here are the people we're hanging our hats on. However, the company is also increasing its marketing costs. At least in the last quarter, it mentioned it as a significant input, which means that our acquisite cost to acquire our next paying customer is going up at a time when we should be able to sort of live off the land, because who doesn't know the name Spotify at this point? Yeah. Who isn't willing to pay the premium price to avoid all of the ads and everything else? And then we're also hearing about how AI slop is such a problem that we're having to spend a decent amount of time finding ways to remove the AI generated audio from the platform, right? The quantity of audio that the companies had to remove from the platform means that there's probably a ton more that they haven't had an opportunity to. And that means their operating expenses are going up once again. So inputs to OpEx at a time when we're trying to grow gross margins doesn't really sound great to me as a shareholder. I don't think that there's a problem with the company in the sense that it won't grow from here. I do think, though, the growth that we've seen where it shot all the way up to like 800 not that long ago, and now it sits closer to 500, I think that its best days are behind it in terms of the stock price, not necessarily the company's performance overall.
Okay, so I hear you on marketing. The AI slop stuff I'm not as worried about. I think it's going to be a pain to clean up, but when you think of how people discover music on Spotify and what people listen to, it's it is a winner take all type of environment. I don't see AI slop like really disrupt. I see that as a pain in the neck for the operation. I don't see that as like as much of a pain for like the customer experience on the platform. I understand that there are costs there.
Doesn't it also though give more pricing power to the 4 major labels that sell their product to Spotify, in the sense that they can always make the argument that what people really want is Taylor Swift's natural voice that she's not going to sue you over, not the AI knockoff of Taylor Swift. And so we can charge you more in our next round of negotiations because the AI slop is so prevalent that people appreciate it more than they did yesterday.
I don't believe so, because Spotify is bigger than the artist now. Think about the artists that tried to go on Tidal.
Oh, Taylor would believe different.
Okay, so there's one. But other artists in the past have said, I need to pull my music off of Spotify. Neil Young got mad at Joe Rogan about vaccine stuff. I'm not going to litigate the arguments here, but Neil Young left Spotify, then he came back. A lot of, I'm trying to think of who the Tidal artists were. I think it was, I think Beyonce was on there. I think Jack White might have been on there for a minute, but I don't have the list in front of me. Nonetheless, Spotify is bigger than, I would say, probably every single artist, maybe outside of your like.
Don't you do it? Don't you get us? 2. Okay, thank you.
Like your top 2. Simultaneously on pricing, they're $13 a month for one account, $22 a month for families. That for something that is a utility, it seems like they may have a little bit of room on that. I don't think they have a ton of room, but if they went to 14 and 23, it wouldn't shock me. And then the other thing that they have in terms of a growth opportunity is local advertising. I wouldn't underestimate that. Active advertisers on the platform up 60% year on year. I think advertisers are still figuring out Spotify. Like when you listen to...
But the ability to monetize that advertising though. So that is a place that I got excited about a year and a half ago, thinking AI generated ads would be a way that they could squeeze the most margin out of ad spend. And it doesn't seem like that is actually the focus. And that then means that advertising isn't really adding that much juice to the overall revenue platform in the same way that it has been for like a Netflix who just introduced advertising for the first time a year ago too.
I'm saying local advertising. Why isn't Malcolm's Chevrolet, and maybe it's not enough to move the needle, but like Malcolm, Ethridge, Chevrolet, and Subaru, why like they should be advertising on Spotify when they realize, oh, we have a ton of local listeners in this area. So I still feel like they have a lot of runway in terms of the advertising business. And to the point of marketing and ad spend, they, I think, are going more in that like hyper premium direction. They're starting to get involved in the ticket business a little bit. They're trying to do the high fidelity audio stuff. It seems like they could play with live events. And so I know that live events has been the answer for a lot of businesses on this show lately. However, I do see Spotify sort of like walking into that more premium subscription experience zone. And for a subscription business, that's where you get a lot of margin.
Well, the last thing I will say on it is I just initiated a buy on Netflix personally. I just started buying Netflix myself personally. It's a very similar business to the one that we're describing. However, Netflix trades for about 20 times forward earnings. Spotify still trades at about 34.
Okay.
One is very much market rate, right? The S&P is trading at like 20, 21 times at this point. Spotify is the premium purchase at this point. So if it does manage to fall back in line with the broader market, I might decide to revisit it. But at this price, I think it makes sense for me personally, who's owned it since like 140. It makes sense to get while the getting is good, because I think that it's going to be a while.
And I've been a long-term shareholder as well. Long-term meaning a few years. I think it's probably like 2023, like you said. What you're saying also makes sense, and I reserve the right to trim when this episode comes out or when you're listening. Just because when you're listening to the show, I'm playing with ideas, and I want Malcolm to push back on me, and I want to push back on him. It doesn't mean that either of us is totally correct or totally incorrect. Do you have thoughts on MercadoLibre, by the way?
So I've never owned this company. I pay attention to it because people love it so much. Like, I have clients that text me about it and are always like, why don't we own this? It's one of those things to me where it sounds like, if I understand correctly, the investments in growth are hurting its overall margins, and that is what's freaking out the street right now. But if I understand correctly, MercadoLibre is a company that always flip-flops between, do we care more about our profit margins this year, or do we care about our top line revenue growth for a decade from now? And if you're a long-term shareholder, you know this flip-flop happens and you're just holding on to it for dear life, and it'll be what it is. And if you're a person looking at it today saying, is now the time that I buy, you have a much harder time squaring that circle.
Yeah, so let me set it up too. This is, if you don't know MercadoLibre, it is, people like to say, like, Kava is the next Chipotle. MercadoLibre actually functionally is the Amazon of Latin America.
Mm-hmm.
And they have a huge, they're working on doing a huge retail distribution and also a payment system. So we can really get you into the life. It's like, what if Amazon also had credit cards? And one of the things that it's had tremendous growth. I think revenue is up about 50% year on year. Profits are down. And one of the reasons for that is they have started issuing tons and tons of credit cards. I think credit cards sales may be up like 75% from a year ago. And so when you do that, you have to put a bunch of money into a pool that's for those credit cards going bad. And so that's been something that has affected the stock price. I am not a Latin American credit expert, the farthest thing from it, and I won't pretend to be one on X. Many people would like to be. And so when I am looking at this company, it's one of those things where I'm like, okay, this is a top dog. If you want to, we've gotten questions in the past, like, how can I get some good companies outside of the United States? This one trades on an American exchange. It's a top dog outside of the United States. It's making bets for 5 years down the line that are pissing off, people holding a magnifying glass to the quarterly results so we can do free shipping in Brazil and, getting more people into our payment system. At the same time, that's eating margins. So it just, I have gotten the same thing from people in my stock circle where they're like, MercadoLibre is an incredible company and one we literally cannot talk enough about. And so it's one of those things where it has had the network effect on me in that sense. So anyway, I was checking in with you to see if you had anything smart to say about it.
The only thing I can say based on what I've heard in the past and kind of what you just said, like an investment in your own payments network and trying to be Visa or trying to be Alibaba or WePay or whatever,
Sure.
Is a decades-long or multi-decades-long investment in your future. So it's similar to the Amazon setup where if you had bought at IPO and just held the shares forever and never thought about it again, you'd have $1 million on a $10,000 investment. it sounds like MercadoLibre is one of those you have to be willing to take that long a view on it to see if the thesis is going to actually work out. You can't worry about it quarter to quarter.
All right, let's wrap up with this question we got from Andrew. Our email, thistimepod@gmail.com. You know where to find us. You can find me on social media. Malcolm has a presence there, but you probably won't get a message back. Question from Andrew. I've been following the markets closely for 1.5 years. So during that time, there have been talks of the K-shaped economy and, quote, the haves getting havier. Sounds like he's quoting you. My question is, how does that trend end up changing, and what makes the lower half of the K be able to participate in what the top half of the K already benefits from? In all the scenarios I think about, either the K continues or both halves go in decline. The economy ends up nosediving. It's hard to picture a scenario where the bottom half of the K trends up unless wage growth skyrockets or prices decline. I have some thoughts on this, but you wanna take a stab at this one, Malcolm?
Well, it's nothing good, I think, is the answer to the question. Like, there's no world in which the top half of the K is going to experience an equal share of pain as the bottom half of the K. So if the top half of the K experiences 20% pain, the bottom half is going to experience 50% pain. So you set this up with your splurge on the TaskRabbit person to come and provide a service to your household that is sort of a discretionary service. You could handle the task yourself. You chose to outsource it. If you think about how much the top end of the K spends on outsourced services and who is actually the person or the people providing those outsourced services, there's a misalignment, right? That top half is asking the bottom half to provide those services. And that, I think, is where it turns into a very difficult dynamic. So we don't want necessarily the K to start to revert back to a singular line all at once, because math doesn't work that way. It's going to be a disproportionate amount of pain felt by the bottom half to get us anywhere close to closing that K.
So I think there's 3 responses. Number one, this question, and Andrew, I'm not calling you a democratic socialist. What I am saying is that there is a rising feeling of like, whoa, this is getting out of control. And that's why you're seeing this type of line, which is, quote, if we lived in a classless society and governed ourselves, we could freely build a world without war or poverty, which is in the democratic socialist, like, what's the word I'm looking for? Platform. And so this type of feeling, I think, is why you're seeing that movement have a huge rise in American society in addition to a bunch of things that, well, I'm not going to get into right now, but you know what they are. Simultaneously, 2 questions with this. One is the investing thesis, which is, should you invest in the upper part of the K-shaped economy? Maybe. I mean, the haves are getting havier. That's something you are noticing. And there are businesses that cater to that. And then the second question I would say is the third part is thinking about it less from a societal point of view and from a personal point of view. That's something I have thought about quite a bit, which is, you know, how do you put yourself on the bottom line of an income statement versus the middle part of an income statement? And that is ultimately a way to financial freedom. Not something that I have totally executed on, but I know that that is something that I'm trying to build and plan at some point in my future. So that is, think about it personally as well.
I think great question. I wish there was a better answer to it, but just the way this country is set up, and who has access to the power, right, at the top, it's just not a scenario where I see the bottom half not getting punched in the face unexpectedly while trying to help bring the top end down to them.
On that happy note, you can find me, I'll say LinkedIn, Ricky Mulvey on LinkedIn. One thing, if you like the show, leaving a few words on Apple Podcasts really helps us out, helps grow the show. People see that there's action coming in on it. So if you have the time to do that, would appreciate you doing so. Malcolm is at Malcolm on Money. Thanks so much, y'all. We'll see you next week.
information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.